welcome to the sixth edition of the Kansas City Commercial Real Estate Market Pulse, hosted by Exchange Commercial Real Estate. I would say this is probably the most anticipated edition of our Market Pulse up to this point. We're joined by special guests today, Rob Meehan. Rob, how you doing today, man?
I'm doing good, Logan. I'm doing well. I think everybody's really excited to see what's about to happen here. So,
man,
it's a pretty exciting day, a very unique time for us to be having this conversation.
Yeah, most definitely is. And we were just speaking right beforehand. Probably would have been a little bit better for us to wait maybe an hour or two to maybe have this conversation. But I think it's going to be really timely and educational in a lot of different ways. Because for me, understanding how interest rates work through commercial real estate, I think, is a fundamental component for brokerage, but also for investors. And I don't think many people actually understand how this works, right? And they may read some headlines, but a lot of times there's so many different factors going on. It's not just what the federal funds rate is. It's not just what the 10-year treasury is. There's so many different components here that we're going to talk about today, but I'm very excited about, and I'm excited about learning from you. So let's go ahead and get started. Look, what we do on a biweekly basis is try to bring the most valuable, up-to-date information on the commercial real estate market here in Kansas and in Missouri, including current listings, any market trends. We're bringing on expert insights and speakers, positioning Exchange as the go-to resource for the market intel that you need to be able to move your investment business forward. We're helping a lot of property owners sell their properties. We're helping new buyers, experienced buyers, buy commercial real estate, identify the right opportunities, and then put their teams in place so that they can be successful. Here's our team. That's me, Logan Freeman, managing broker here at Exchange Commercial Real Estate. There's the rest of our team, Katie and Nick, Chad, Nathan, Max, and Micah. But today we've got a good friend, a dear friend and colleague of mine, Robert Meehan. He's a managing director at Greystone Capital. Rob, you've been at this thing for 19 years. You know, the last 14 years being at Greystone. You've seen some markets, ups and some downs. I would like for you just to characterize, before we get started today, talking about Federal Reserve and interest rates and capital markets, but is there a period of time that you can characterize, like right now, comparatively speaking, over the last 19 years? Does it remind you of any period of time? One of my favorite quotes is, from Mark Twain. I think he said something along the lines of, history doesn't repeat itself, but it sure does rhyme. Is right now rhyming with any other period of time that you can remember?
I don't think there's a perfect corollary through my career for what's going on right now. I think there's plenty of instances where massive change in the markets, right, created a lot of uncertainty. But I think the unique piece of today's market is that if you ask 100 people what's wrong with the market, you'd probably get like 20 different responses.
Yeah.
Whereby in 08, 09, 2010, right, it was a collapse of a financial market. Everybody kind of understood what was going on, right? It was a very clear, this is what happened, right? And all of these things happened thereafter because of it. And now we're in this period of time where there's so many kind of intersecting issues that are then creating spin-off issues. And some people take them as opportunistic. Other people see it as, the sky is falling. But there's no super clear path forward. And, I think the Fed, meetings and the focus on Fed cuts is just another evidence of that occurring. We're going to see a Fed cut today. Rob's willing to bet the house on that. Is it 25? Is it 50? But I think the immediate impact people think this is going to have is maybe overstated because they've been waiting for this for so long, right? We're now in we're about 12 months from when we thought this process may have begun.
Absolutely.
And I think for some aspects of commercial real estate, it's going to be very impactful. And others, I think what owners and operators are hoping for, unfortunately, may not come to fruition as quickly as they think. And it just feels like a time where there's a lot of different opinions, but not sure anybody really has it nailed down as to what the truth is.
Well, before we get into all of that and unpack some of that for our listeners today, tell everyone what you specialize in, what Greystone does, and what you've been doing for the last 19 years in the commercial real estate sector.
Absolutely. Yeah. So Greystone is one of the nation's largest providers, right, of agency debt platform products. So we're talking Fannie Mae, Freddie Mac, FHA HUD, right? Primarily multifamily housing, seniors housing, student housing, manufactured housing. We basically, if you can live in it and it's not a single family home, we generally have some form of product for you. And beyond those, we've kind of built out our platform to include, we have our own CMBS placement, right, for maybe alternative types of real estate, such as industrial, retail, office. And then also we have bridge and mezzanine funds. We have pref equity pieces. We've kind of completed the debt stack for folks where we're really trying to be a one-stop shop. The firm itself is tremendous. It's in its 35th year. It's family owned and operated. We're privately held, so we're not a publicly traded company. We have the benefit of when someone says, well, can't you go to who's in charge? We actually have a guy who's in charge. He owns the place.
Sure. Yep.
There's not a million shareholders. And so it's just a great family environment to build a career with. Hence why I've been here as long as I have. There's always options to kind of make, lateral moves to competitors, but Greystone's been home.
Absolutely. And I will say, not just Midwest, because I know you do a lot of business outside of the Midwest. That's just where you're at right now, but you're not originally from the Midwest. Where are you originally from, Rob?
I'm originally a Northeast guy, so I'm a New Yorker by trade. I've been out here, though, in the Kansas City market for 10 years now, so kind of adjusting to Midwest life. And I'd say the biggest differences are people here are significantly more polite on a day-to-day basis. But conversely, your pizza's not as good. So that's all.
It's true. That's exactly true. Yeah. No, if you're in and around the Midwest, obviously reach out to me. I get you connected to Rob, but also, I mean, he can go national. You can go anywhere in the country. And there's very few. Look, I get conversations going with mortgage bankers, people looking for financing leads and want to connect with me on a regular basis. I mean, every single day. And Rob is one of those guys that I actually go to and bring deals to and have conversations with for two reasons. One, I know what Greystone can do, and I've seen what they can do. And two, we're going to get it shot straight, right? Like, I don't need someone to tell me, here's what I think we can do, and then issue a term sheet that is completely different and not indicative of where the market is. And so if you're interested in connecting with a real person in the capital markets that knows the capital markets, knows how to get deals done, and will tell it to you straight, definitely reach out to Rob. He's been a great resource for myself and for our team, and I've really enjoyed getting to know you over the last, 4, 5, 6 years. So for quite some time now. So thanks for being here, Rob.
Oh, my pleasure. Thanks for those kind words.
All right. So a couple of weeks ago, Jerome Powell kind of shook up the industry in a way that said, hey, the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risk. So I think really, like you mentioned, Rob, the only ambiguity about coming rate cuts is not if, it's how many and how much, right? And so I think a lot of people have been prognosticating on if it's going to be a 25 basis point cut today or a 50 basis point, but also watching and dissecting. I mean, I can't imagine being the guy that has to give a press release and then financial firms using artificial intelligence and analysts picking out how many words he, specifically used on this topic versus this topic, and then making, investment bets on that stuff. Like, it's just pretty, I got to believe that's pretty stressful gig to have. But a lot of people are going to be watching that press conference today as well to try to see what he's signaling here in the near future. One of my favorite individuals who's been doing this for longer than I have been alive is Dr. Ed Yardeni, and he wrote the book Fed Watch, and I just loved reading all of his insights and understanding how closely people actually watch the Federal Reserve's chairman speeches and what that does for the impact of the commercial real estate market. But when this happened a couple of weeks ago, people got real excited, and myself included. And I think that was because not just of the actual impact of maybe the federal funds rate declining substantially over the next 12 to 15 months, but is really the investor sentiment and the psychology around investors, because we deal with individuals buying $1 to $5 million transactions typically, and they're reading the headlines, but that's really about it. So they are influenced heavily by the sentiment that's out there. And Howard Marks talks a lot about that in his books of the investor psychology and how that can swing the pendulum to one side or the other. It's not always rational, right? There's a lot of irrational exuberance going on in capital markets as well. But one thing I wanted to just ask you, Rob, was, from some emails that we shared back and forth before we get into actually understanding federal funds rate, 10-year treasury, and where mortgage rates actually are and how they're impacted. When he came out and signaled this a couple of weeks ago, the actual market itself reacted. And I think that is shown here by the implied federal funds rate based on 30-day futures, right? And you had sort of mentioned this earlier in this episode was, look, the impact could already be baked in to the 10-year treasury. So talk to us a little bit more about how that actually plays out. And even though the federal funds rate was not, reduced at that time, he just signaled that it would be, the 10-year treasury and the futures, the federal fund rate based on the 30-day futures definitely impacted and made a move. So tell us a little bit about your thoughts on that.
Sure. I mean, I think people sometimes get confused at the federal funds rate, right? It is a short-term interest rate. That's what we're talking about. Short-term overnight money lending costs.
We're talking about like credit cards and loan, like car loans potentially, business banking loans, those types of things, right?
Correct. And in a more precise way, what does it cost banks to borrow money from the federal government, right, for their daily operations? And so I think everybody can agree that banking has gotten tighter as the federal fund rates ran up. Right now, that was a focus of a couple of things. Number one, if banks are paying more money for their cost of funds, right, they're going to charge more money for their products and services. That's just a natural cause and effect of the economy. And that's natural, right? So that made it harder for folks, let's say, to buy a home, right? We've seen a major slowdown in home buying in most markets because interest rates took off. But with all that is the backdrop of how COVID impacted the market, where we ended up with this massively inverted yield curve where, right, the 30-year treasury is supposed to be higher than the 10-year treasury, which is supposed to be higher than the 5-year, which is supposed to be higher than the 30-day. That is the natural course of economics that our entire economy is based on. And when that flips upside down, the federal fund rate kind of becomes the 800-pound gorilla in the room, for lack of a better statement, because everything is inverted, right? To borrow money for a day is theoretically cheaper than to sign on to borrow for 30 years. That doesn't align with business practices.
That's right.
And so we are now entering a period where the federal funds rate is not only coming down, but the inversion of the treasury yields is actually balancing itself back out, where longer term treasuries are again more expensive than shorter term. And so we are essentially getting back to what I would say maybe is a more normalized market condition. And to think back to when that last occurred, we're going pre-COVID. Before we were in that period of a seemingly reasonable forecast for federal funds and longer term treasury yield options.
Oh man, I couldn't have put that any better. If you really just want to understand how this whole system works, go back about a minute and slow that down and just listen to that, because it took me a whole economics textbook to read and understand exactly what Rob just said in about a minute or in a minute and a half. You have to understand that we have not been in a normalized interest rate or yield curve situation for quite some time. And we're going to talk about that. I have some graphs to actually showcase exactly what that looks like and what that visualizes here very soon. But let's talk really quickly about how high interest rates impact commercial real estate. Obviously, it impacts the borrowing costs, right? I mean, increased rates raise the cost of financing for commercial real estate. You have decreased leverage due to higher borrowing costs affecting your return on investment. There's changes in investor behavior. I mean, just look at the commercial real estate market. I mean, we were last quarter, the first quarter of 2024, we were at the lowest level that we have seen of apartment transactions in Kansas City since about 2008. So it had been extremely impacted in regards to changes in investor behavior. It happens around multifamily and construction starts as well. Yeah, this year we have a lot of deliveries coming online. Next year we have a decent amount of deliveries coming online. However, if you look at starts for this year or last year, extremely, extremely low. And so that's one thing to keep in mind in regards to supply and demand when you're looking at investment decisions is, yeah, I mean, there's certain markets in the Sun Belts and other areas of the United States where we're talking, we've never seen this amount of supply coming online. And that can be worrisome for some. But if you look at it from a longer term growth perspective, these last 2 years probably going to balance out pretty quickly. So acutely, there may be some pain, but chronically, it looks like it's going to balance itself out. The third thing I want to always talk about is the long term market impact. I mean, this is really crucial. I mean, like the commercial real estate market for the last 2 years has been really not shut down, but a lot of the brokers, a lot of the vendors in that marketplace have been impacted drastically because of prolonged periods of high interest rates. Transactions don't just benefit real estate brokers. We've got financing, we've got construction, we've got property management, we have all of those different components. So these high interest rates have impacted commercial real estate and other markets in the economy, obviously, but commercial real estate drastically over the last 2 years. And I think that's indicative of why we have started to see a lot of these groups like Lone Star, JP Morgan, and a few others raising billions of dollars into funds, getting ready for the next wave of transactions. Because, and I didn't add this into our discussion today just because I knew we wouldn't have time to get to all of this, but if you look at the Green Street Property Price Index and where we're at right now from a basis standpoint, we peaked, I think it was in May of 2022, of about 155, and we are back to 125 on that basis for the Green Street Property Price Index, which is very close to pre-COVID levels. And if you were just to take the last 4 years and just add in normal inflation and appreciation, we're at a pretty good level from a basis standpoint, regardless. Yes, we've had some big peaks, we've had some big valleys, but right now, seemingly, for a lot of folks, if they can figure out the financing and figure out the right deals, it's a good time for basis. And I think that, combined with a lot of dry powder on the sidelines, is going to create this waterfall effect that I've been kind of writing about quite a bit. And I think the next 2 years, at least, we're going to see a lot more transactions and higher asset values for a number of different reasons. And when I see Bob Knackel, he's back. He's a New York City guy. Bob Knackel, most decorated commercial real estate broker probably of all times, right? Just thousands and thousands of transactions. He's going for 3,000, I think, before his career is done. He is calling for next year, so 2025 and 2026, the stock that he has been tracking for over 35 years, the highest level it's ever retraded, that stock was 4.6%, or maybe it was 4.3%. He's basically saying and forecasting that the next 2 years are going to be above 5% from a transaction value standpoint. So love your thoughts on that and how high interest rates have impacted commercial real estate up to this point, but maybe your thoughts on the next couple of years. And do you agree with Bob Knackel, with myself, that the big transaction wave is coming, and how are you getting ready for that?
Yeah, I mean, listen, right? We operate in fairly short cycle windows. They don't run as long as I think people sometimes believe they do. And so the incredibly low interest rates that were created via the early 2020s, right? So you already had very aggressive cap rate purchasing, very high per unit. And then we entered a period of time where our treasury yields were 70 basis points.
Yep.
Right. That drove pricing higher. It just drove the market into what I would say a frothy area. And a lot of people were lucky. They were able to, potentially, if you already own something, right, you got great refinancing terms and you held on.
Right.
Conversely, if you bought something during that period, you're probably hurting a little bit now on your basis for it. But the fundamentals of investment real estate is still incredibly strong. Vacancy is slightly creeping up. It's expected to continue because as the federal fund rate comes down, home buying becomes easier, right? Mortgage rates go down, becomes cheaper. More people have the ability to buy a home. But Logan, you know as well as I do, if you drive around the neighborhoods of Kansas City or really anywhere else in the area, you're not seeing first-time home buyer building going on. These are not starter homes, right? You're looking at homes getting further and further from the urban core, but the price is staying high because they're building bigger and they're building higher amenities to maintain a very high price per foot. And so it's creating this vast kind of gap between the deliverables of the homes that are being built, right? Who is actually eligible to even buy these? And how that impacts the rental market, where we've heard for years now, right, the talk of more and more people renting longer, putting off or not being able to make that first home purchase, and how that all correlates back to, investment real estate, right? If you've got if you've got a larger tenant base for your mixed use complex, then you're going to have a stickier tenant. You're going to be able to probably push rents. Well, as you start pushing up rents, you're going to probably have an ability to push in a better retail tenant, right? A higher end type operator who might be seeking that type of nearby potential clientele, who's got the ability to pay a higher rent and thus can probably afford maybe their more luxurious goods than a mom and pop retailer. And so it all really ties together. But I guess in a simpler way to say it is, I agree. I think we're about to enter a really busy part of the cycle after a lot of people were sidelined just due to misaligned market conditions.
Yeah.
Right? High rates and a lot of people who maybe felt they missed the window to sell. So we did not have sellers actively looking to transact as they started hearing that their potential sale price was lower than it maybe was, 12 to 24 months earlier.
I think that's a great point, Rob, and one that I want to just make sure I reiterate, that there was many folks that were waiting for yesterday's pricing, but they missed the window. And as prices continue to rise, or potentially continue to rise, that could create a lot of transaction activity. Not only that, there will be folks that did buy when the basis was, or the indices was at 155, and it has gotten back up a little bit. They will seek to get out of those real estate deals and potentially try not to lose all of the equity, but try to get some back, or try to refinance at that time as well. So I think there's going to be a flurry of activity, and I'm excited for a little bit more deal activity, but also excited because we've been planting seeds. I know you have too, for a long time. It's been 12, 15, 18 months of talking with people, making sure that they understand where we're at in the market. And I think for sellers, it's really hard to really gauge and time the top of the market. And so if you're thinking about selling your property right now, what we're saying is, with what we're going to be talking about today with interest rates, but with also buyers kind of sitting on the sidelines getting ready to deploy, there might be a really good opportunity to find an opportunity to sell your commercial real estate property. On the flip side, with buyers right now, investors have been sitting on the sidelines for quite some time. We're just now starting to see institutions really get back into the game over the last 15 to 18 months. So excited to see that those guys making some transactions, because a lot of people look to them to say, okay, they might know something that we don't, but they're making moves. Let's start to make some moves. But also, for a buyer, your deals might start to pencil again here, because you may be able to find a rate or find financing that does help to make your deal make more sense. I'll caveat that with, look, we're in a different period of time. Investor return expectations have to be reset to what the market is currently. So if you're a sponsor, you're a broker, you're working with people who are trying to invest or trying to sell or buy properties, I think that we have to eliminate the frantic measures that were taken during COVID and say, look, real estate is a longer term play. And that was a lot of people playing some short-term gains, and some people made it and they did really well, and some people did not. And so making sure that we reset market expectations, which I think has been somewhat done and permeating throughout the marketplace, because from the property owners that I'm at least speaking about, they get that like 2022 prices are gone. But if they're back on the rise, it's going to be hard to figure out like when the top actually is. But as long as they're rising because of interest rates and because of the capital that's ready, might be a good time to think about selling. And for buyers, your deals might start to make a little bit more sense. But there is going to be this period of time, maybe the next 3, 6, 9 months, where people are still kind of waiting to get in, and those first movers where you find where prices are still at that 125 industry level, but interest rates are coming down and financing is getting a little bit better for your deals. Might make a really good little sweet spot to tackle some opportunities here in the next 6 to 12 months. So excited to see kind of how that plays out and how that impacts the commercial real estate market. And we are definitely ready for a change. And let's not forget that there is the most contested and or debatable election coming up, right? So that's one thing. We have geopolitical risks all over the world. We have growing wealth and poverty gaps, as Dalio talks about drastically in his book, The Changing World Order, and posts about on a regular basis on his newsletter on LinkedIn. Please go check that out. Really, really appreciate what Ray Dalio does and his views on the economy. Highest and or most successful hedge fund manager of all time, and has written a number of books that I really, really enjoy reading. And I think he has a good worldview as well, because he's done a lot of work in other countries. So there's a lot of other factors at play here too. But today we're trying to focus down on the commercial real estate market. So let's finally get into some of the content that I prepared for us, Rob. How about that? 26 minutes in. Okay. So we've talked about there's almost 100% certainty that the Fed is going to reduce the core interest rate, the federal funds rate, right? This meeting today. And they predict that over the next 2 years, we should see that rate go down from about 2% from today, so near 3%. The question on a lot of real estate investors' minds is, how is this actually going to impact mortgage rates? And so what I tried to do here is just break down the federal funds rate, the 10-year treasury, and mortgage rates. And I want to preface this with, we've talked about this. This is in a normal economic condition where we do not have a inverted yield curve, but we do right now. So just keep that in mind. But mortgage rates are typically directly related, and this is on the single family home side, maybe the CMBS side, but directly related to the rate of return on mortgage investments called mortgage-backed securities, right? So they're going to fluctuate up and down based on how much investors are willing to pay for MBS. And this would be on the single family home side. So I just want to make that distinction here. But I think it's just helpful for people to maybe understand how these mortgage rates work. So, and that MBS rate is highly correlated to the 10-year treasury yield, which is the interest rate the government's paying on 10-year treasury bonds. And this is because most mortgages last about 10 years before they're paid off. So investors will often move money from 10-year treasury bonds to mortgage securities, or vice versa, depending on their risk tolerance. So in other words, the first point being here, mortgage rates will fall at some percentage, typically above the 10-year treasury yield. Now, what's different right now, Rob, on this front is that the 10-year treasury is below the federal funds rate, which just gets people really confused. So clear that up for us.
Sure. Yeah. I mean, if you think about it, right, if you're in the space, you've looked and you've probably been like, wow, trying to get a bridge loan, let's say a floating rate interest rate loan is incredibly expensive for the past 2 to 3 years. Making it even more expensive than just the underlying rate is you have to go out and buy something called a rate cap, right? Which is basically taking away the high end risk of rates running up. And from 2020 on, that cost was probably a 5 to 7x the historical number, because it seemed like the federal funds rate was a runaway train, right, in an upward direction. And nobody wanted to be holding the other side of that bet, where suddenly they were called to pay out. Now, inversely, with the federal funds rates, predicted to drop here within the next hour, and then continuing to drop into the future, right? People are now re-entering the floating rate debt space. They're interested now in doing short-term floating rate loans, taking on bridge opportunities for value add programs, because not only are they anticipating like, hey, my rate might not be great today if I'm getting a good basis, but it's actually probably going to go down over time, not up. And secondarily, the cost of those caps is normalizing itself, because now the cap providers are expecting that they're not going to actually have to pay out on any of these for multiple years because of the expected future curve.
Makes a lot of sense. Thank you for that. So what's the percentage premium between the 10-year and mortgage rates? What's the historical view been? Today, it's about 2.6%. So mortgage rates are about 2.6% above the 10-year treasury year. But historically, red line here, that premium is lower at about 1.6%, right? So
Yep.
if we get back to a normal set of circumstances around interest rates and mortgage rates, we should expect mortgage rates to sit somewhere above the 10-year treasury rate, about 1.5%. So I think that's just a point to be made here, because as we're looking at this graphic of federal funds rate, 10-year treasury, and mortgage rates, we need to know what that historical spread has typically been. Now, on that front, you had mentioned to me, let me just orient people to this as well. So where should we expect the 10-year treasury yields to go as the Fed lowers the federal funds rate? And this is where I want to kind of have a couple discussion points here. But again, if we look to historic data, this red line here, which is the historical average, assuming that we get back to a normal set of circumstances around interest rates and treasury yields, we should also expect treasury yields to sit about 1.5% above 10-year treasury yields. Now, Rob, you made a really good point here. And this was kind of the point being that we were talking about earlier, which is, yeah, but what if the 10-year treasury is at a pretty good spot currently, and they could be already baking in some of the sentiment and the signaling from the Fed, right? So, let's talk about your position here with 10-year treasury yields and this historical average being about a 1.5% above, the 10-year treasury.
Yeah, I think the interesting thing here is I do think mortgage rates are going to go down, but I think a lot of people are looking at it from the wrong part of the equation. I think they're looking at it as, oh, the Fed's going to cut the federal funds rate, and thus the 10-year treasury is going to come down. I do not believe that to be the case. I think historically where we're at right now in the 360s, 370s is a healthy place for the 10-year to be. What the federal funds rate change is actually going to do is increase competition in the debt markets, right? As money becomes cheaper for lenders, more lenders are interested in getting involved.
Absolutely.
The more lenders involved, right, the tighter spreads get. It's very simple, right? The reason we got to the spread level I believe we're at now, like you said, it's maybe 100-ish over what we would normally expect to see is, again, I hate to keep banging the drum, go back to when the treasury was at 70 basis points.
Yep.
As a lender, I could charge you 275 over the treasury and you're getting a sub 3.5% interest rate. Why do you care?
Right.
Now, treasuries have increased significantly since then. And as a lender, I think there's an easy way to look back and go, look how much money we were just making.
Yep.
Look at the profit. Let's just keep it, right? We're just going to hold that line. And it drove rates up very significantly, and it had a negative impact on the flow of business into the market. So I actually don't believe the 10-year treasury is going to see a big impact. I think it's already been baked in over the last 30 to 45 days. If you just check out the chart, like after the last Fed meeting, after no activity, but basically it's going to happen next time, the treasuries fell off, right? They sold off. The yields came way down, and that's where we're at today. And now minutes before our next update, treasuries are up day over day because it's already in there, right? People are probably selling off and trying to take their profits, take their losses. So I think we're at a healthy spot. I think what we're really looking towards more is the total interest rate people are going to be paying. I suspect that a year from now, there's going to be far more players back into the space, and that's going to force everybody, the agencies, private lenders, debt funds, community banks, to kind of tighten up, right? That ability to say, well, there's not that many people active, so there's enough food for everybody to go around isn't going to be the case anymore. And that's where investors are going to see the opportunity whereby, right, you always want to know what your spread is. You want a good spread, but at the end of the day, it's the interest rate that matters.
Yes.
Right? What is your rate? What are you paying on for your debt? And I think we're going to see those numbers continue to dip through the rest of 2024 and really probably through 2026.
Absolutely. So that's why we have a capital markets expert come in and actually explain from the lender's perspective, total interest rate cost, right? So in other words, yes, the more normal economic situation, this is how this works, right? It's your federal funds rate. You got a spread between that and the 10-year treasury. You got a spread between that and mortgage rates. We're not in that environment. We're trying to get back there. It seems like the economy is trying to get back there. But as I mentioned, the Fed expects rates to drop near 3% by 2027. But while this is a big decrease from where we are today, and assuming that historical, we get back to our historical averages, we're likely only going to see mortgage rates come down about a half point this is on the single family home side, with 30-year fixed rates landing somewhere around 6%. And it's because of all these factors that we've already talked about. But with the increased competition in the commercial real estate space, that could really shake things up. And so there's a lot of factors at play in all this. But I think the big takeaway is that I don't foresee, massive interest rates, cuts. I from a total interest rate standpoint, Rob, where do you think that we may be, from a percentage basis standpoint, right? So like, let's just say, we're putting out debt, or we're putting out lines right now at 6.5%. When the Fed gets done with all of this, we don't get back to 4%, 3.5%. We're somewhere between probably 5 and 5.5%, right? More of a historical average.
That's probably a very healthy economical place to land for the economy as a whole. I mean, I think sometimes it gets overlooked that when rates run way down or run way up, yeah, there's people who take wins and losses in that scenario, but on the whole, the average person is losing. It means there's a massive imbalance in the economy that needs to be adjusted for everyday operations. And so I think, 10-year money in that, mid fives, low fives pricing range not on a yield basis, on a pure, that's your mortgage rate.
Yeah.
I think that's probably a healthy future, and maybe just some stabilization of rates is going to help lenders get more comfortable as they kind of get back into pushing debt service levels and trying to really be aggressive on their cash flowing, because there's hopefully less concern about this idea, what we just ran into, which is a lot of people took money at really low rates. And as those loans were coming due, as those bridge loans were coming due, as maturities were rising, suddenly, right, you had modeled an exit at 4%, and now you're exiting into a market at 6.5%. Right. That doesn't work. You could have executed, I say all the time, the last 2 years have been the only time where someone could have executed their bridge project to a T. They got the rents they wanted, they did it at cost, and it occurred in the timeline they anticipated. And the back end of the market, just the timing of when they were done, is actually what undid the deal because of the market conditions. That's not the normal, and it's hopefully something we can avoid, these big swings, up and down, and over the next 10 to 20 years in the economy.
Yeah, that's a great point to be made. I mean, that stabilization side, that's really important for investors to understand and get comfortable with doing transactions, because you can't make the assumption that everybody's going to hold something for 10, 15, 20 years. I mean, typical, investor syndicator is getting in and out between 3 and 7 years, so they have to be able to try to prognosticate at least on what the market's going to be at that time, because man, that, as we both know, you can take a financial model and move that terminal cap rate from 5.5 to 4.5, and it makes everything look really, really good. But nobody knows exactly what that's going to look like on the exit. So really good point there. And all of that is very important, because this is, and I couldn't find data up to 2024. However, this was from Marcus and Millichap. I thought this was really good, because when people think about the commercial real estate risk premium, we're talking about rates and cap rates, right? And I've got some charts here to maybe have a little bit of a contrarian view here coming up on the fact that cap rates and interest rates do not always move in lockstep. And I'm going to showcase, some scenarios where that happened. But typically people are trying to figure out, okay, if I buy this deal, all cash, my cap, or sorry, I'm going to say not all cash, but my cap rate is 7%. What's my risk premium that I need to have between that and the interest rate? Well, that has been really thin here over the last 18 to 24 months. And so as we potentially, have to start seeing some of these, interest rate cuts, where will the actual cap rates be? Well, that's the question that has to be discovered. That's the discovery in the marketplace of what, sellers have been holding on and waiting for prices to continue to rise. But I think this risk premium, and I love your opinion on this, but I think this risk premium over the next 2 years is going to get back more to a healthy average. And if I look at the historical averages here, it's somewhere between 250 and 400 basis points. I don't necessarily know exactly where the risk premium is right now, right? The average cap rate in the 10-year treasury. But I know for the last 15 to 18 months, that spread's been very thin and very small, probably closer to 150 to 200 basis points, maybe at most. I don't know exactly what that is. I should have had that, but I have this data here from 1990 to 2022, and the average has been between 250 and 400 basis points. So I think that investors are looking at this and saying, okay, well, if I can go get my total interest rate, my total debt cost is going to be 6%. Well, then I need to go buy an 8% cap rate deal or an 8.5% cap rate deal. Whether or not those deals are going to be out there, I think that is the $1 million question for people to find. Or Rob, do you think that these risk premiums, people are going to start accepting a little bit smaller, risk premiums, and or just because they're better than they are now, they're going to feel like they're getting a deal?
It's a tricky question. It's if you kind of dial it back a little bit, right? I'd say if we looked at the average buyer of a commercial property between 2018 and let's say 2022, 9 out of 10 of those deals are some form of a syndicator model.
Yep.
Right. It's you've got a warm body who's got the expertise, who uncovered it, but they need to go out and raise funds. Since that time period, I'd say probably 70% of purchases are family office style or investment grade real estate, right, for a fund, because they're operating on a little different of a basis plane, right? They don't have to have these outsized or maybe significant optionalities into the market to generate the cash they need to complete a deal, right? They're using their personal wealth, they're using family funds earned over years, and so I think the risk premiums have actually gone up over probably the past 2 years simply because sales were so infrequent. The general sale was either, if it's a large class A, it's probably one institution to the next. And by and large, they're kind of recapitalizing their books, right? Somebody's got to take a loss. Somebody's got to add a property to the portfolio. Somebody else needs to free up some cash. It's a little less relevant, whereby then you move to the smaller, the B's and the C's, and you're looking at more family office investment. And they're looking for really high returns because truthfully, since COVID, the fundamentals of operations have gotten a little harder too. You've got people who are not paying rent as frequently as they maybe did before. In many markets, evictions got very challenging. I do think these numbers will flatline some because we're going to see a big pickup in transactional volume. But there's a lot of distressed real estate out there, which is going to probably keep the margin high because there's going to be buyers who think there's a better deal out there if they just kind of keep their eyes open and looking.
Absolutely. And always have to keep in mind market conditions, property type, location, and quality of asset, right? It's very hard to take a graph like this and apply this to your specific investment strategy. This is on an average cap rate and likely the sales that Marcus and Millichap is tracking themselves, right? And so, and the best data that we get is typically on larger, newer assets. And that's the same with the Green Street Property Price Index. So keep that in mind as well. Now, I've had a lot of conversations with people, maybe some spirited conversations. I'm not going to say dates, but Dr. Peter Lemon put out a really nice research article probably 7 or 8 years ago, and they really tried to find out the correlation between cap rates and interest rates, and they do not always move in lockstep. However, on LinkedIn and on other platforms, I have heard, and I just saw, I posted today about Fundrise, a large crowdfunding platform, making the statement that cap rates and interest rates do move in lockstep specifically, and they think that where we're at with interest rates coming down, that asset prices are going to go up. Now, I don't disagree with that actual assumption. However, I think there's other reasons, such as the economic land cycle that we're in, the business cycle that we're in, and some other things that we're not going to speak about today. However, I just wanted to see if you have done any research and or thoughts on if you believe cap rates and interest rates move in lockstep. And I'll just say really quickly before I go into any more detail on this is it's not necessarily interest rates, because we can see here on these charts that interest rates and cap rates don't. Oh, look at them. I mean, you see some serious difference in movements here over the years. However, it's capital flows that have the correlation. And capital flows, yes, a lot of times are dependent on interest rates, but not always, because there's different markers and there's different groups that have, let's talk about non-bank lenders, right? Non-bank lenders getting into the industry right here very, very recently and raising billions of dollars of funds, right? So they have a different risk profile. They have different oversight, and there's going to be money that comes to the market. So wanted to ask you, if you've done any thoughts or done any research on cap rates and interest rates moving in lockstep. If not, I would love to share this research piece by Dr. Matt Lariva and Dr. Peter Linneman that showed that the percentage of GDP equated to mortgage debt is much more correlated to cap rates than actual interest rates are.
Yeah, I mean, I'd love to see that. I think what people need to remember is, right, interest rates move instantaneously. Cap rates do not. Cap rates are a lagging indicator of the broader market, right? For cap rates to go down, there needs to be strong sentiment pumping into that particular space, right? That's going to drive that down. And that takes time, right? You sign a contract, you close 60, 90, 120 days later. Over a 120-day period, the interest rate can move 100 basis points in the marketplace, right? It has nothing to do with your transaction. The market continues to spin around you.
Yep.
So there's going to be a lag, right? Interest rates are going to move before cap rates do, unless you've kind of got a crystal ball and you can time it. But admittedly, we have customers now, again, the family office who's coming to us going, hey, I'm about to lock up this deal and I'm going to actually execute like a 7-month close. And we're like, well, 7-month close, that's going to be a brutal loan process, right? With updates. And they go, yeah, but I know that gives me 6 months till I have to lock in my interest rate.
Oh, wow.
Right. And they're trying to capture that delta. We're getting the cap rate at today's numbers, but we believe we're going to then yield a return on our investment because we think rates are coming down. And it's not something that everybody can do. I think if, most guys who are out there raising funds from people who, aren't friends and family would probably get looked at sideways to make a commitment that's, not going to run for 7-8 months, but it's possible. And I think that's where things are going, and I think I always say, follow the smart money, right? You follow the multi-generational family ownership and see what they're doing because they're usually pretty accurate because they are not in the business where they have to transact.
Yeah. Well, that's really interesting. It reminds me of a similar strategy that I've heard some people kind of implementing, which is going and buying or locking up land that is developable land, right, in a good area, path of progress, putting an 18 to 21 month option contract on the land, working through the entitlements and approvals process, getting that in place and selling that and or closing on that or selling that land to someone else at the end of that option contract when they have the ability potentially to develop because of where interest rates have come down. So similar kind of concept, right? It's a little bit of the timing of the market, but like very interesting strategy. I had not heard that some family offices are implementing that, but that is a very smart move if you can get that done. Very interesting, Rob. I hadn't heard that yet.
Yeah, no, I think the land play itself is fascinating. I think it's a good point.
If you can got a question here.
Get someone to give you a price today, but lock up the ability to close later on after you've improved it. It makes a lot of sense to me.
Absolutely. So, we probably got time for one of these questions. Might have to shoot you an email to get to some of these other ones. However, this is the big debate: is should the Fed cut 25 basis points or 50 basis points today? Your thoughts and or reasoning on which one?
Well, they just announced 50 bips and I've been watching it. So I'm not going to take. My bet was actually going to be on 25. More so just because of the election versus anything else. This move is very close to an election date, which is not common, but I think they put it off for so long because of the other indicators that it really became necessary. But then you look at the market and I'm watching, CNBC Treasury yields. They're less than 1 basis point different from where they were when the market opened this morning, right? It's the proof that this was long anticipated. It was baked in. I guess we can all speculate if 50 basis points if it was 25 versus 50, what that would have meant. But I really don't think there would have been a lot of flow difference here. I think what we're now going to start seeing is these short-term yields dropping faster and people are going to pull money back out because a lot of people took their cash and they put it into 30-day Treasury CDs. Yeah. Why not? Right? Go invest in 30-day SOFR and just keep rolling it over at 5.5%. It's a good return with no risk. I think that model's gone. And so we're going to see a lot of significant wealth flow back into the real estate markets because people need a place to earn interest, right? They want to earn premium on their dollars. And the safe short-term Treasury buys I think today is the start of that being a thing of the past.
Well, you heard it here first, unless you're watching CNBC or one of the other news outlets live. 50 basis points cut by the Federal Reserve. So one of the economists that I follow, and this will be our last point here, but I thought this was he put this out 2 weeks ago. And he said that the Fed officials could learn a trick from other quantitative disciplines. And let me just read you this. If you have 12 hours of security camera footage and are trying to find the moment when thieves break into a store, the fastest way to narrow it down is to start in the middle. So if the store has already been robbed, then you go back 50% to the beginning, so 3 hours in. Or if not, move 50% closer to the end, 9 hours in. And suppose you do this and find that the store was robbed somewhere between hours 6 and 9. The next step is to go to hour 7.5, halfway between, and repeat that process. Pretty soon, you'll find the exact moments you were looking for, and all without having to stare at a screen for anything close to 12 hours. Right? I thought that was really cool and really well put. I mean, and so that's kind of what he was reflecting on for the Federal Reserve, where the Fed tried to something similar. It'd be roughly equivalent to lowering the policy band to 3.25 to 3.5% immediately, and then waiting to see what happens. That seems to be around where traders and Fed officials think the neutral zone is. So futures markets pricing implies that there's a 74% chance that the Fed's policy will between 2.5 and 3.25% by September of 2025. And so I thought that was an interesting way to think about trying to find this neutral zone for the Federal Reserve, right? And I hadn't thought about, if somebody robbed me and I had all of that footage to actually start in the middle, then figure out had I been robbed yet, and then go 2.5 hours in or 2.5 hours back and start in the middle there. Just some quantitative disciplines there. And it seems like, the Fed may be adopting a little bit of that here. Now they're not dropping it to 3.25 or 3.5% drastically immediately, but 50 basis point cut is, I think, substantially different than 25 basis points. What all eyes will be on what Fed Chair Jerome Powell's presser is going to be like here in the near future. All right, Rob, do you have any closing thoughts before I just get through some slides on some upcoming events that we've got? Anything else that you wanted to talk through? We very much appreciate you being here. You broke down so much in regards to the 10-year Treasury, inverted yield curves, understanding the total debt costs, all of those components. But anything else that you wanted to touch on?
No, I think we're about to see a big influx of, interest amongst debt providers, which should hopefully benefit, all the investors on this call as they are out in the market, seeking loans. I would just always advise people to don't just take things on the cover of what the interest rate is, right? Really dig into the terms of who you're dealing with, what those specialty conditions of your loan are. Are you covering recourse versus a non-recourse loan and those kind of things? Because I think there's plenty of people who maybe 5 years ago signed a recourse loan thinking no big deal, who would tell you very differently today that they wish they hadn't done so. And so really just everybody, really think about the process of obtaining debt in a more complete manner, and don't just always focus so much on rate dollars. It's not the be all end all of most transactions.
The last 53 minutes didn't convince you that you need to reach out to Rob and have a conversation. Let me do that, because Rob is an expert. He's going to shoot it to you straight. He knows his stuff. Just re-listen to the last 52, 53 minutes of this episode. And if you want to get in contact with Rob, he's easy to get in contact with. Shoot me an email. Find him on LinkedIn. He's easy to get in touch with, and we can make that happen. Next Monday, we've got our third annual Together We Win golf tournament. Sponsorship is for Operation Breakthrough, a great nonprofit organization here in Kansas City. So we're going to be playing golf in 5 days. Rob, you going to be there?
Yeah, I got a team. We're ready to roll.
Awesome. So we're going to be playing golf. It's supposed to be beautiful out there. Should be a lot of fun. You can find me also on Thursday, October 10th at Contractors, Closers, and Connections here in Kansas City from 5 to 8. Exchange Commercial Real Estate is sponsoring this event, and we're excited for everyone to come out. These are a lot of fun. These events have great attendance. They're not cheap to come to, so don't complain to me about the ticket price, because people that you want to meet with are there. The food is good. The drinks are good. The entertainment's great. It's just a fantastic place where contractors, people in the commercial real estate place are all making connections. So Thursday, October 10th from 5 to 8, make sure to be there. Also in October on the 23rd to the 25th, I'll be speaking and at the Cash Flow Summit here in Kansas City, and that is at the Overland Park Convention Center. So make sure to use my awesome promo code Logan at checkout for a special discount. If you can't make those, feel free to join us at our next multifamily meetup groups. We've got one coming up next week, Wednesday on the 25th, October 30th, and then we're getting back started in January. If you liked what we talked about today, if you want to get in touch and speak more about multifamily, commercial real estate in Kansas and Missouri, in the Midwest, you need someone to help you think through financing with Rob, make sure to get in touch with us. Here's how to do that. I'm very easy to get in touch with. Shoot me a message, shoot me a DM. And I am very excited that the Fed cut 50 basis points. But like we said here, there's a lot of factors in regards to your total interest rate costs. And you need somebody on your team to be able to help you understand all those differences. And we can help find those properties. Rob can help finance those properties. And we're excited to talk with you. So, Rob, thanks again for joining us. Thank you all for joining. We had probably the most people here live, and I think it was because Rob's handsome face was here talking about interest rates and capital markets. But we'll be here again in 2 weeks, likely talking about something really fun that I like to talk about, which is the 18.6-year real estate cycle, Ricardo's law of economic rent, and what that means to you as an investor. So thanks for being here. See you in a couple weeks.
Thanks, Logan.
Thanks, Rob.